U.S. Treasuries took down.
Listen up, Rebels. Rebel Leader here, and this week, it's been crazy volatility, and this is somewhat expected. As we go along in these highs, we'll see some pullbacks, right? So we see this roller coaster, up and down, up and down. But overall, it's been a good week. Overall, we're still up. It's continuing this trend, for the month-long trend of going up. And you can just look at any chart, going back 1 to 2 to 3 months, the trajectory is up. It's a clear straight line, right? So now, what stocks have had, the greatest, increase, and where is the opportunity lying for the future summer, right? So, the stocks that have seen the most growth in the past 3 months are NEO. I know it's hovering around $45 a share today. That's great. We wanted to get back up to 60. And I was buying the whole dip. I hope you were. And now we're at a good midpoint, right? At NEO at 45. But if the shares we bought at 30, that's all pure gains. And don't worry, if we bought it at 50 or 45 around this price range, we're just getting back to break even, and now we're gonna really take off for the next 6 months. Then you have Revolve. Now Revolve has been, hovering around this $50 mark, which is great. Again, I always thought this was a $100 stock as a price target, and now it's broken into the $60 range and hit that resistance line, and it's going good. And this is important because as we keep breaking through new highs, Revolve just hit an absolute all-time high at I think $62 or $64 just yesterday. And that's, it's great news. There's a lot of foundation, solid, financials around the stock, and the base of fashion and, these companies that it's just very profitable. The baselines of fashion companies in general are very profitable. But if you remove the brick and mortar retail stores from the equation, if you're not paying rent, or you're not paying employees to sell in the stores, if you just have to really upkeep your website, the profit margins increased almost tenfold. And where this is going to go, the brand reputation that they're building and the brand loyalty that they're building, Revolve has far more potential where I see it could be in the next 5 to 10 years than many other companies. But again, you would have to really understand the fashion industry. You would have to, there's a lot of things you would want to do before you really, invest heavily into Revolve. But every time I look at the stock, I'm like, man, I should be investing more. It's always easy to go, I wish I got more shares at $8, at the $20 a share range. But I got a lot of shares. I think, back then, I got a lot of shares. That was literally, I was putting everything at the time into Revolve. And now we're seeing where it's at today. And now I'm thinking, I want to put even more at the $50, $60 price range. Just to keep buying, because as the brand keeps building, it gets more valuable. So it makes more sense that it's worth more now than it was back then, because it was more speculative play. Now it's just a high growth stock. And now where this stock is going, nothing's really changed in the vision of this company, but the numbers are staggeringly improving every quarter, every earnings call. And then that's really what's, building this trust, and, Wall Street's starting to take notice of this company now. So as we keep on going up, I think this is going to be a great stock for the next few years. I'm going to hold on to all of my shares. I'm going to start maybe thinking of buying more at this price range. And the last stock that has been great this week is Lemonade. And this stock, it teetered out around $70 a share about a month ago. And now it's building up momentum. And again, it was just the market's slope that it really just went down the rest of the market. Nothing in the fundamentals changed. No news came out. That's really what should get you, really in your high conviction stocks. You should be investing heavily more when you see that the stock price dips for almost no reason, because that's when that it's just gonna rebound. As it always does, it always dips and it comes right back up. So Lemonade about a month ago was hovering around $70 a share. Now it's at $105 a share, and it's still nowhere near the $200, to the $200 price target a lot of Wall Street has on this company. But also, it was just at $180 a share in February, right? So it's coming down a long way, but it still has a lot of runway to go. This is a good time to keep buying some shares of that. But you can expect some volatility in all these stocks and in the broader market for that, just because that's kind of how it works. And you kind of have to know how much volatility you can handle, right? And it's not even really risk, because if you stay long enough in the stock market, you understand that stocks generally only go up, and over time, it really isn't as risky as you might think. But right, so it's more about the volatility and how you check every single day, or maybe you check once a week your stocks, and you see that it goes up and down, and some people can't handle that. Because if you lose a few thousand in one day, then it comes to question, and then you sell out, then that's a loss, right? People think they lose money because of the volatility. They really don't. They lose the moment they decide to sell out the stock. So if you can't handle the volatility, there's an easy answer. Put all your money into an Apple, put all your money into an Amazon. These stocks that are tried and true and have been for around 20 years now. And you can just look at how these stocks have performed over the last 20 years, in fact. And, they'll probably have the same returns, crazy returns in the next 10 or 20 years. If you hold Apple right now at $100 a share, it could be worth $1,000 a share in 10 years. There's no doubt in my mind that that's a very good but strong potential of where Apple can be. And if you're holding an Amazon, that company is a growth beast, and there keeps adding new things to their business model, and they keep buying and you keep integrating, and they not only have a monopoly in multiple areas, they probably any market they enter, they probably could have a monopoly, just because of their brand reputation and customer loyalty and just brand awareness in general, honestly. And if they can synergize all their companies with the Amazon name, a lot of people will just buy it just because it's purely Amazon. They would rather trust Amazon over a no-name company, or even a company that's, maybe only has 10 years or 20 years behind it. It doesn't have an Amazon, which, has, decades behind it, but also it's just a global powerhouse at this point, and it's the delivery. It's just so much you have into an Amazon stock, right? But what we're talking about is volatility is extremely low in these stocks, and I have not even seen these stocks go down. That's not to say they can't, but something like an Apple, a Facebook, or an Amazon, and even a Google, these stocks barely even went down during the March, COVID crash last year. So that kind of should give you a sense of, when the entire stock market is crashing and falling down, these stocks are the pillars and held it up with the big tech. And this is kind of expected because these are the best businesses in the world, right? So there's really no volatility, as they bring in tons of revenue every single year. They have so many people working for them, so many employees, and they keep doing better business and doing bigger business, right? So as more people keep buying their products, they'll keep inventing new ones, they'll get the repeat customers, and of course, population keeps increasing. As you can see, it's a very, very profitable businesses that these companies are running, and at the point where the government is now trying is the key word, trying to break them up with some anti-monopoly claims. Whether or not that happens, I think it won't happen, because if one company breaks up, there's so many details and minutia that I don't think government can even have time to handle, and even they don't even probably have the know-how to handle it. That's In my experience, bureaucracy and government in general is highly inefficient. So I would be massively surprised if they wanted to go into an Amazon or a Facebook and say, no, you can't do this. This is what you can do. This is how you can operate your business. And this is how you not become basically how you can split your one company into smaller companies and run them, basically. I would be, I can't even picture that. That's kind of so crazy and far out there. But we'll see. We'll see what happens. I think some people have good intentions. Some people just really want to see these companies being broke up just because they think they're getting too big. But the reason they're big is because they are the best, and people want to use them and buy them. And then at that point, you're kind of taking away from the customers as well, not only the big companies, right? If Amazon, it benefits everybody, especially the customers. If Amazon can enter new spaces and deliver within 2 days or less, they want to enter drones, they want to deliver with drones next and all these things. They're thinking about it. It literally only benefits everybody and the betterment of the world, right? So that's kind of where I see you want to put your money. Again, if less volatility, you would put it into one of these big 4 tech stocks. And again, you can just look at what these stocks have done. This isn't a surprise, right? It's literally called the FANG of big tech, right? The FANG stocks. Facebook, Apple, Google, Amazon, Netflix, and Google. That's FANG, right? So the question becomes now: Can you handle the volatility? Are you okay waiting a year or two for these stocks to kind of blow up, and where you might take a more conservative, longer approach with these stocks, the FANG stocks? It won't go up as much as, say, a Revolve can, or as much, say, a Palantir can. It's not high growth anymore. So that's kind of a personal question, and it's really something you have to ask yourself before you enter a stock, so you don't make the mistake of losing money. And that's one of the biggest mistakes beginners make, is they don't understand how volatility works. They don't understand how their reaction to volatility will play out. And if you can't see, again, we make emotional decisions all the time, but this is really, the stock market is not a place for that, because that's how you lose money. And we always want to avoid losing money, and going into it with a plan and high conviction is how you don't lose money. And again, long-term visions. When I say long-term, I'm talking about a year. Put your money in a stock for a year before you pull it out or see how it does. And again, you always have to compare it against a benchmark. Compare it against if you put all your money into Apple. Compare your portfolio if you could put all your money into Amazon. Did it outperform it? Did it do better? Worse? And if it did worse, you might as well just throw everything into it. And again, this is something that you have to come across with more experience as you're building through the years. I myself am starting to realize a lot of things that I could have maybe handled better or been approached a little smarter. But again, it's really just starting out and having a long-term vision. So volatility and vision, that's kind of the recap of this week. Rebel Leader, over and out.